I need to share something with you about the invisible signals flashing before every market collapse, something that most people don't understand, something that threatens not just your financial security, but the very fabric of our open society. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day. You may know me as a hedge fund manager who generated returns of over 30% annually for 3 decades. Or perhaps you know me as a philanthropist who has given away over $32 billion. But what I really am is a philosopher who happens to understand financial markets. And what I understand, what I've built my career on understanding, is that markets are always wrong. Not sometimes, always. The only question is, by how much? Before we continue, I encourage you to subscribe to this channel. The ideas we discuss here challenge conventional wisdom and are based on decades of experience. What's happening right now in financial markets is a perfect example of what I call reflexivity, a concept that will help you understand not just this crisis, but every financial crisis. Most economists believe that markets move toward equilibrium, that prices reflect fundamental reality. They're wrong. Markets don't just reflect reality, they help create it. The participants' perceptions influence the fundamentals, which in turn influence perceptions, creating a self-reinforcing feedback loop. And right now, multiple invisible signals are screaming that we're approaching a critical inflection point. These signals were present before the 1929 crash, before Black Monday in 1987, before the dot-com bubble burst in 2000, before the 2008 financial crisis. They're patterns of human behavior, reflexive processes that build to inevitable reversals. By the end of this video, you'll understand the philosophical framework that has guided my investment decisions for over 60 years, and what you need to do to protect yourself from what's coming. Let me start with a proposition that most economists reject. Markets are always wrong. They don't reflect reality, they help create it. Right now, we're witnessing a convergence of warning signals that experienced investors recognize. Consider the Buffett Indicator, the ratio of total market capitalization to GDP. This metric, which Warren rightfully calls probably the best single measure of where valuations stand, currently stands at 223.5%. To put this in historical context, in January 2026, 223.5% during the 2021 peak, 211.5% during the 2000 dot-com bubble, 153% during the 2007 housing bubble, 105% historical median since 1950, 80.5%. Conventional theory says these changes represent market efficiency, but what I see is reflexivity at work, perceptions creating a reality increasingly divorced from fundamental economics. Let me explain. There are 2 functions in financial markets: the cognitive function, where participants try to understand reality, and the participating function, where their actions change that reality. When these interact, they create feedback loops that take markets very far from equilibrium. In the case of current market valuations, here's how the reflexive process works. Rising stock prices create the perception that markets will continue rising. This perception drives more investment through traditional accounts and, critically, through borrowed money. Margin debt reached a record $1.23 trillion in December 2025, up 36.3% year over year. This borrowed money pushes prices higher, which confirms the original perception, attracting more leveraged investment. This is not a free market correcting itself. This is a self-reinforcing boom that will inevitably become a self-reinforcing bust. Understanding fallibility is crucial. The participants in this market are operating with imperfect understanding. They don't see reality as it is, they see it through biases and misconceptions. And these misconceptions aren't passive. They actively shape the reality we're trying to understand. Let me show you how far perceptions have diverged from fundamentals. The market concentration has reached unprecedented levels. The Magnificent Seven stocks Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla now represent 37% of the entire S&P 500's market capitalization. Just 7 companies control more than 1/3 of America's stock market value. In 2015, these same 7 companies represented only 12% of the S&P 500. This threefold increase in concentration in just a decade creates a dangerous illusion. Investors believe they're diversified when they own S&P 500 index funds, but they're actually making a massive concentrated bet on 7 companies. The trend is built on a misconception, the belief that these valuations are sustainable, that concentration reduces risk through the quality of these businesses. When trends are built on misconceptions, they eventually collide with reality. That collision is what we call a crash. This pattern always ends the same way. Always, every bubble has 2 components: an underlying trend that prevails in reality, and a misconception relating to that trend. When positive feedback develops between them, a boom-bust process begins. The underlying trend, the AI revolution. There is a real change happening in technology and artificial intelligence. Nvidia's revenue doubled year over year, driven by genuine demand for AI infrastructure. This is the truth at the core. AI represents a fundamental technological shift comparable to the Internet revolution. But this trend has given rise to a misconception that current valuations already price in decades of perfect execution, with no competition, no regulation, and unlimited profit margins. The forward price-to-earnings ratio for the S&P 500 now sits at 2.5, the highest level since the dot-com peak of 1999 to 2000, when it touched 25. I've seen this before. In 2000, the Internet was real, but the valuations assumed a future that couldn't possibly materialize. Companies with no profits traded at astronomical multiples because participants confused a real trend with unlimited profitability. The misconception drove behavior that reinforced the trend, creating a self-fulfilling prophecy until it wasn't. Market fundamentalism. The invisible hand mythology. There's an ideology at work: market fundamentalism. The belief that markets are always right, always move toward equilibrium, that government intervention is always wrong. This ideology is itself a misconception that prevents necessary regulatory action to prevent bubbles from growing too large. Consider that defensive assets, treasuries, utilities, and gold all moved higher in unison during September 2024, a historically rare signal that traditionally precedes market corrections. Yet the market continued climbing, sustained by the belief that this time is different. I'm not against markets. I've made my fortune in markets. But markets need guardrails. Without regulation, they will go to extremes. They always do. The yield curve, perhaps the most reliable recession indicator, inverted for a record 16 months from July 2022 to November 2023. This was the longest inversion in modern history. Every recession since World War II has been preceded by a yield curve inversion. Yet market participants convinced themselves that traditional indicators no longer mattered. Who benefits? The concentration of power in every bubble. Some profit from the misconception. Right now, the beneficiaries are a handful of mega-cap technology companies and the financial institutions facilitating leveraged speculation. The top 10 companies in the S&P 500 now account for roughly 35% of total market capitalization, up from 18% a decade ago. This isn't just concentration of wealth, it's concentration of risk. In 2024, only 28% of S&P 500 stocks outperformed the index itself. This was the second narrowest market participation since 1995. The breadth is collapsing even as prices rise, a classic late cycle signal that sophisticated investors recognize immediately. This is a reflexive loop of power. Economic gains create the perception of invincibility, which creates valuations generating paper wealth, which creates more economic power, until the loop reverses. The threat to open society. What concerns me most is not just economic damage, but the threat to open society itself. When market crashes occur, they don't just destroy wealth, they destroy faith in institutions, create conditions for populist backlash, and enable authoritarian movements. I survived Nazi occupation. I've seen how economic crises can destroy democratic institutions and create conditions for authoritarian regimes. The wealth inequality generated by these boom-bust cycles where insiders profit while ordinary investors suffer catastrophic losses erodes the social contract that makes democracy possible. When this bubble bursts and middle-class investors lose their retirement savings while wealthy insiders have already repositioned, it creates exactly the conditions for democratic backsliding that threaten open society. This is about more than money, it's about the survival of the institutions that protect human freedom. To understand where we are in the boom-bust cycle, we need the macro context. The Federal Reserve has begun cutting rates from their 5.5% peak, now sitting at 3.5 minus 3.75 as of December 2025. But this cutting cycle is occurring in a fundamentally different context than previous cycles. Central banks operate under their own misconception. They believe they can manage the economy through interest rates alone. They can influence trends, but cannot prevent reflexive processes from taking hold. In the reflexive process, we typically see stages. Stage 1, the trend underlying change begins. AI revolution, genuine technological advancement. Stage 2, the misconception, participants misinterpret sustainability believing current valuations are justified by future growth. Stage 3, the boom misconception and trend reinforce each other. Record margin debt, extreme concentration. Stage 4, the test reality pushes back. We saw this in April 2025 tariff shock, August 2024 yen carry unwind. Stage 5, the climax. If trend survives, conviction strengthens. The VIX spiked to 65 in August 2024, then markets recovered and conviction grew stronger. Stage 6, the reversal trend becomes unsustainable and collapses. Based on my analysis of current market conditions, we are currently between stage 5 and stage 6, the most dangerous moment. The market has survived multiple tests, which has strengthened participants' conviction that nothing can stop this rally. This is precisely when reversals occur. Here are the specific signals. The VIX, the market's fear gauge, remains relatively subdued despite record valuations, trading around 15. This complacency in the face of extreme valuations is itself a warning signal. Historically, when volatility is priced too low relative to actual risk, sudden repricing events occur. Margin debt crossed $1.2 trillion, with investors now owing $817.8 billion more than they have in cash, a record negative credit balance. This creates a hair trigger for forced liquidation if markets turn. Let me show you what this means financially for the average investor. The median U.S. household with retirement accounts has roughly $87,000 in 401k savings. If the market corrects to historical valuation norms, bringing the Buffett Indicator from 223.5% back to the 80.5% median, that represents a potential 64% decline in nominal values. For that median household, $87,000 could become $31,320. That's $55,680 in destroyed wealth per household. For 60 million American households with retirement accounts, that's over $3.3 trillion in aggregate losses. But when this bubble bursts, and it will, those most exposed will lose far more than paper wealth. They'll lose the ability to retire, to pay for education, to weather economic hardship. The social consequences will echo for decades. The global dimension. This isn't just domestic. Record U.S. market valuations have created distortions across the global financial system. The dollar's strength, driven by capital flows into U.S. equities, has stressed emerging markets and created currency vulnerabilities reminiscent of the 1997 Asian crisis. I've lived through currency crises. I've seen how problems cascade through the global system. In 1997, what started in Thailand spread throughout Asia. In 2008, subprime mortgages nearly brought down global finance. The interconnectedness we see today, with global investors piling into U.S. tech stocks through leverage, creates conditions for similar contagion. When the reversal comes, it won't respect borders. Let me tell you what you need to do, both to protect your finances and help preserve open society. First, embrace fallibility. Recognize your understanding of current markets is imperfect. Mine is too. This recognition is wisdom, not weakness. Be flexible. Adjust as new information emerges. As I say, I'm not better than the next trader, just quicker at admitting mistakes and moving on. Nobody can time the exact peak, but you can recognize when risk-reward has shifted decisively against you. Second, understand reflexivity in your decisions. Your actions are part of the system. Ask yourself, am I following this trend because it makes fundamental sense, or because others are? How might my misconceptions be shaping my decisions? What feedback loops am I participating in? Would I make this investment if everyone else wasn't? Third, protect yourself strategically based on where we are in the boom-bust cycle. Here are specific actions. If heavily concentrated in U.S. large-cap tech, begin systematic reduction of exposure to Magnificent Seven stocks. Target reducing concentration to no more than 20% of portfolio. Redeploy capital to undervalued international markets, particularly emerging economies if moderately positioned. Increase cash reserves to 15-20 of portfolio. Consider protective put options on S&P 500 index funds. Diversify into assets that perform in reflationary environments. Commodities, value stocks, international equities if already defensive. Maintain discipline. Being early is not the same as being wrong. Focus on businesses with pricing power and low leverage. Consider asymmetric opportunities that benefit from volatility spikes. Key principle: don't try to time the peak. When I see a bubble, I rush in to buy, but I watch for the inflection point when the reflexive process begins reversing. Look for these specific signals. VIX sustained above 25, margin debt declining for 3 consecutive months, market breadth deteriorating, fewer stocks making new highs, credit spreads widening, persistently defensive sectors outperforming for 90+ days. Fourth, engage politically. This is a policy problem requiring political engagement. Support candidates who understand systemic risk and financial regulation. Advocate for regulations preventing excessive leverage and concentration. Oppose policies that enable too big to fail dynamics. Support progressive taxation that reduces destabilizing inequality. Fifth, think systemically. Don't just protect your narrow interests. Support policies that reduce systemic risk through counter-cyclical capital requirements, prevent excessive wealth concentration that threatens social stability, maintain central bank independence from political pressure, foster genuine competition rather than winner-take-all monopolies, strengthen the institutions that make open society possible. The survival of open society depends on citizens who think beyond immediate self-interest. Your financial decisions and your political engagement are both part of shaping the system we all inhabit. Let me conclude with the two ideas that have guided my life: fallibility and reflexivity. We cannot know reality perfectly. Our understanding is always imperfect, distorted by biases and limitations. In financial markets, this creates opportunities but also catastrophic risks. The investor who admits fallibility can adapt. The one who believes certainty is possible will be destroyed by surprise, and our perceptions don't just reflect reality, they help create it. The feedback loop between thinking and reality drives boom-bust cycles. This is not a flaw in the system, it is the system. The invisible signals before a market collapse are following a pattern I've observed throughout my career. Extreme valuations built on the misconception that this time is different. Record leverage amplifying both gains and inevitable losses. Concentration masking itself as strength. The trend is built on misconceptions. The misconceptions reinforce the trend. Eventually, reality will assert itself, and the adjustment will be painful. But we have agency. We can recognize the misconception. We can interrupt the feedback loop. We can prevent catastrophic outcomes for ourselves and for the open society we cherish. This requires intellectual honesty, political courage, and systemic thinking. The conceptual framework of fallibility and reflexivity has helped me make billions. More importantly, it's helped me understand the forces shaping our world. I hope this framework helps you navigate what's coming. More than that, I hope it helps you become the kind of citizen open society needs to survive what lies ahead. The future is uncertain, but we can shape it if we understand the process we're part of. Thank you for watching.